Moody's and ICRA have launched their India Credit Outlook for 2021, and they believe that the Indian economy's recovery is on track and higher fiscal spending will further boost the rebound in the next financial year. However, given the large debt burden and the low medium-term GDP growth, fiscal consolidation remains weak. The report finds that asset quality of banks is better than expected, but muted investor appetite at public banks means they will require capital infusion to meet their requirements. Distressed assets at NBFCs are also expected to rise as the coronavirus shock continues to weigh on several key segments. As far as corporates are concerned, things like payment moratoriums, additional funding lines, one-time restructuring options have enabled the stressed ones to successfully navigate the challenging environment. So let's straight away get to the authors of the report, and joining me now to speak about the sovereign and macroeconomic outlook are Jean Fang, the Associate Director, Sovereign Risk Group at Moody's Investor Services, and Aditi Nayar, the Principal Economist at ICRA. Jean, let me begin with you first. In many ways, India has been one of the worst impacted economies because of the pandemic. What's in store for 2021 and what are the key credit challenges ahead?
Well, we have seen a very encouraging rebound in the economy so far in India in the start of 2021, and we're forecasting actually quite a encouraging rebound of 13.7% in terms of growth for the fiscal year ending March 22. So that's all very encouraging in terms of the rebound that we're currently seeing. When we look further ahead, it's really going to be about the ability of the economy to sustain levels of medium-term growth that are consistent with our baseline. And we're forecasting 6.2% growth going forward beyond March 22. So that's going to be important in particular because we think that the real growth rate is going to drive nominal growth, which will be critical to managing the fiscal trajectory for India going forward.
All right. Aditi, what's your sense? How long before we return to the pre-pandemic levels? Jean was saying beyond FY22, we're looking at a 6% kind of a growth.
Thanks. We are actually forecasting that the recession in India has ended already. So we have a growth forecast of 0.7% for the Indian economy for Q3 of FY21. So in a sense, we're back to the pre-pandemic levels in the December quarter. But of course, it's on a very low base of the December 2019 quarter. When we look at the disaggregated data, we got a huge improvement across, a very broad-based improvement across the sectors in Q3. And what we found was that most sectors actually returned to a growth. And that's something that is very encouraging in terms of the resilience, at least of the formal sector, in being able to get back to the pre-pandemic levels. Having said that, the informal sectors will definitely take longer to heal, but the lack of adequate proxies for them is actually constraining the analysis about whether the broader economy is going to be able to come back to pre-pandemic levels in a durable manner very soon. We do expect a modest uptick in the pace of growth in Q4 and then a return to pre-pandemic levels through FY22.
All right, Jean, India expects its fiscal deficit at about 6.8% in FY21 and then at 9.5% before it returns to 4.5% by FY26. That's a long time away. How concerned are investors about these kind of fiscal deficit forecasts?
Sure. I mean, I think that the 6.8% fiscal deficit was wider than we originally expected, but what that really brings to mind is the very challenging balancing act that all governments are now facing between, on the one hand, continuing to support growth through fiscal accommodation, and on the other hand, trying to reinstill some degree of fiscal discipline. Now, we do think that the 6.8% deficit target seems very realistic. We do think that the governments use rather conservative estimates for nominal GDP growth, and their revenue targets are reasonable, which is in of itself encouraging. But I think what's more important is that in the overall balance, I think that the bias, if you will, towards growth or supporting growth remains important, as we do see recoveries globally being very uneven, and the ability to secure a solid foundation for recovery in India is very important from the credit perspective. Looking further ahead, we have considered the fact that a 4.5% deficit target in the year 25-26 incorporates a rather modest degree of fiscal consolidation. That is baked into our assessment of overall government debt to GDP, which we expect to stabilize at around the 90% level, probably just under 90%. That's a very high level compared to other BAA peers, but what's important is that nominal growth is sufficient enough to allow for some degree of stabilization around those levels going forward.
Would you look through some of these higher numbers, as you said? Will it not impact the ratings in the near term?
Well, I think in the context of all other sovereigns globally, we've seen a very similar shock that's caused debt levels as a percent of GDP to jump up across the world. So, I mean, India is no different in that respect. India will remain an outlier amongst BAA peers in terms of having a very high level of debt to GDP. But I think what's more important for us is that we see some ability in the medium term to stabilize those levels. And I think it's a trajectory that tends to be more important right now than the level. In the longer term, the level will be important because that means at higher levels of leverage, you have thinner buffers in the face of future shocks. So that is important. But in the more medium to near term, I think the trajectory is what we're quite focused on.
Well, Aditi, India's inflation for the better half of last year has remained above RBI's comfort level, except the last couple of months where it's actually come to around 4 or 5% levels. With core inflation remaining very sticky, what is your sense going ahead? What is the outlook on the inflation front?
Thanks. So, we think that the last that we got for January was probably the bottom, and we are going to see inflation rising back up closer to 5% over the next two prints. And for FY22 as a whole, we expect that the inflation will come down to around 4.5% from the 6.1% that we're projecting for FY21. So overall, there is likely to be a decline in inflation, but we do think that it's going to remain higher than the current target of the Monetary Policy Committee in terms of the midpoint of 2 to 6% band for the third year in a row. So this is something that we need to be watchful of in terms of how much the CPI inflation actually ends up exceeding that 4% midpoint of the target range. And what we are concerned about is that with commodity prices going up and with demand coming back globally, pricing power is also increasing, and therefore core inflation is unlikely to see a very sharp dip and is likely to exhibit a lot of stickiness. Another concern, of course, is that the rebound in crude oil prices has been transmitted very quickly into fuel prices, and it's been exacerbated by the fact that the taxes on such products in India are very high. So these factors are likely to keep inflation above the midpoint of the MPC's target band, and therefore we think that the rate cut cycle has ended, and we are expecting to see a extended pause through 2021.
All right, so you're expecting no rate cuts for 2021. Jean, to wind up the discussion, quickly give us a few factors that would lead to a rating upgrade for India at this point of time, and adversely, what could lead to a rating downgrade?
Well, I think we've currently got India at Baa3 with a negative outlook. So what we would really focus on is risks to the downside of our baseline forecasts. And, primarily those are all risks that could lead for growth coming in weaker than what we expect. We're still concerned about the health of the overall financial system. I think I would definitely say that the banking system has averted the worst case scenario, which is reassuring. But at the same time, we would expect levels of credit to pick up in terms of growth to much higher levels as the economy begins to recover, and higher levels would be consistent with our medium-term forecast of around 6%. In addition to that, I think, as always in India, execution is very important, so we want to see the government be able to execute effectively around the budget that we've recently seen, and that being able to support growth into the medium term will be an important factor as we continue to monitor the outlook.
All right, Jean and Aditi, thanks so much for joining us here. Thank you for your time. Okay, let's get talking about the outlook for the corporate sector from Moody's and ICRA. Vikas Halan, the Associate Managing Director, Corporate Finance Group at Moody's Investor Service, and K. Ravichandran, the Executive Vice President and Deputy Chief Rating Officer at ICRA Limited, are with us now. Vikas, to begin with you, when do you expect the corporate sector will see a more meaningful recovery, especially the sectors that have been most hit by the pandemic this last year?
Yeah, that's a million-dollar question, isn't it? The corporate sectors across the board have been hit by the pandemic, and not just in India, globally. There are some sectors which have been hit more than the others, mostly the consumer sectors. But overall, pretty much everyone has seen the impact, maybe except for those who rely on digital services. Now, in terms of the recovery, 2021 will see a meaningful recovery across the board, especially in India, where we have seen the virus is much better controlled than some of the other countries, and we have seen government easing some of the lockdowns. Of course, there is always a risk of the lockdowns emerging if there is a second wave, but for now, if you go by the recovery expectations, India being a large domestic market, even the travel industry in India, which has been hit hard globally, will see some bit of recovery. Also, the consumer sectors in India have started seeing recovery. We have seen recovery in auto demand, we've seen recovery in retail and housing. And across the board, if you see the interest rates being low, will also propel the consumption further and create investment demand.
Ravichandran, how effective have been some of the measures that have been announced by the government so far, whether it is extending credit lines or even from the Reserve Bank of India allowing that moratorium relief, even the restructuring? To what extent has it helped corporates?
I would think, these measures have helped a lot in terms of, the credit quality, of the borrowers. While the moratorium during the period March to August helped to, conserve the liquidity, the various liquidity boosting measures in the form of additional working capital, sanctions, or for that matter, emergency credit line guarantee scheme. So these enable the companies to, stay put even while, the demand environment was gradually improving. Now with the, one-time restructuring also, being in place for some of these stressed sectors, while the patronage is not that good for this OTR scheme, but nevertheless, because of the various liquidity boosting measures from the government, both, the weak corporates as well as really strong companies which are rated AA and AAA, even they were able to mobilize money through this LTRO, TLTRO, etc. So funding was never an issue, which enabled the corporates to stay afloat.
Okay, Vikas, coming to you, what we've seen in this environment of benign interest rates, really large corporate profits, and this is coming with no real backing of capex. So what do you make of this and the detachment that we're seeing in the financial markets and the real economy? Is this really irrational exuberance, as the Reserve Bank of India also recently highlighted?
Yeah, I mean, the corporates borrowing right now is more a function of showing up the liquidity rather than capex. Given the kind of uncertainty that we have seen over the last 12 months, liquidity was the only thing that provided us as well as credit rating agencies comfort around taking a very measured approach in the rating. So if you look at the rating downgrades, really there were 2 rating downgrades out of 22 companies that we rate in India. That was purely because of the pandemic. It was not a downgrade, it was a negative rating action and changing the outlook to negative. So far as there's a detachment between the real economy and the financial market is concerned, that's a much broader discussion. And it has to do with the liquidity that is available.
Vikas and Ravichandran, thanks very much for joining us here and sharing your outlook for the corporate sector in 2021. We'll slip into a short break on that note, but don't go anywhere. We'll be right back. Joining us now to speak about the banking and financial sector outlook are Alka Anbarasu, the Vice President, Financial Institutions Group, Moody's Investor Service, and Kartik Srinivasan, the Senior Vice President and Group Head of Financial Sector Ratings at ICRA Limited. Alka, there have been some concerns time and again through this past year that the pandemic will cause stress to rise significantly, restructuring the Supreme Court standstill order that is masking the extent of bad loans, and now, with large banks like SBI telling us that asset quality will actually be better than what we had expected. What is your own sense? RBI, for instance, says that gross NPAs could rise to 13.5% to 14.8% as of September, as per its stress test. But could we do better?
On asset quality performance so far for the 9 months, which was the key period of the pandemic, asset quality performance of Indian banks has surprised us on the positive side. So both new NPL formation, we take into account the Supreme Court stay, but despite that, pro forma NPLs, restructured loans, all have performed much better. To your question on the RBI stress test forecast, 6 months ago we had put out something similar, and we were also expecting NPLs to increase to that extent somewhat within the banking system. But right now, looking at the performance, we expect a sharp hit to asset quality. The scenario of a sharp hit to asset quality has materially come down.
Okay, so is there a forecast you have for where the slippages or the gross NPL ratios would be for the end of this year?
So on slippages, we look at slippages net of recoveries, and we are looking at a ratio which is somewhere around 2% of gross loans or slightly lower than that. And to put the number in context, at least 6 months ago, we were looking at a number which was closer to 3%, slightly more than that, because we have seen slippages from all segments of the banking sector loan book materially come out at a lower end than what we were expecting at least 6 months ago.
All right, Kartik, in terms of which segments are seeing stress, in the previous cycles it was always the corporate loans, but this time around, everyone's raised concerns about the retail stress rising. What is your own sense, Kartik? For instance, Crystal says retail stressed assets may double by the end of the year.
As compared to the earlier times wherein the stress, as you rightly said, was largely emanating from the corporate, this time with the pandemic, the adverse impact has been far more widespread. And we did expect the stress to play out on the SME segment and the self-employed kind of a segment, which to an extent has played out. We are seeing rising delinquencies in the retail asset class over the last 9-12 months. We also need to factor in that a large part of the corporate stress has already been identified over the last couple of years. So in that context, the incremental slippages or the incremental stress is largely emanating from the retail stroke SME segment. But at the same time, the various measures by the regulator, by the government, and the recent pickup in the economic outlook again seems to suggest, like what Alka said, for the overall asset quality. Even out here, the pressures on the retail asset quality, we believe, has come down as compared to our earlier estimates. In fact, when we came out with our outlook last month, we've toned down our earlier estimates. Earlier, our estimates were possibly the retail NPAs, the NBFC NPAs would possibly go up to about 7.5% from the levels of about 4.5% as of March 20. We are now turning it down to closer to about 6.5 kind of the levels, given the resilience shown by the broader segment of the economy and also the reported numbers and the lower quantum of restructuring, which the entities have so far declared following their Q3 results.
Alka, what is your sense on the level of provisioning that banks have made? Public sector banks that Kartik mentioned, there is that 20,000 crores of capital infusion that is lined up for the year. Private banks have gone ahead and raised capital. Are they adequately covered to be able to bear any unexpected shocks from here on?
Yeah, so there's some good news on that front. So first of all, legacy NPLs or the cases in NCLT are largely provided for. So average provisioning coverage for those NCLT cases are close to 90%. And on the average provisioning coverage of public and private sector banks is over 70%. So the legacy loans are not going to cause more burden, more provisioning burden for the banks. Having said that, on the topic of capital, yes, private sector banks have taken the opportunity and raised capital, so they are fundamentally stronger to ride on the growth potential once it comes through. But for the public sector banks, while they don't need capital for Basel norms, they all meet the minimum Basel norms. But the capital allocation from the government is fairly modest, and that would only support modest credit growth for these banks and perhaps not let them grow in the same manner as we expect for the private sector banks.
Okay, so enough capital to meet minimum regulatory requirements, but not to grow. But Alka, what is your sense on the budget announcement that two public sector banks are going to be privatized? First, any guesses on who they could be and what it would mean for them?
It would be speculative to guess names. We'll let the government announce the names. Having said that, there are two direct implications of privatization. So first, if we are rating those banks, then from a rating perspective, it is credit negative because we will incorporate lower amount of government support into those banks' ratings, like we do for private sector banks currently. So in that context, the ratings may have negative pressure. But to the other point on privatization, we think privatization will be positive for industry structure. Making those banks market-oriented and doing some reforms would lead to a positive market structure over the medium term.
Okay, so negative for the banks, but positive for the sector. Interesting. Kartik, finally, the last word from you on NBFCs. Access to capital remains a challenge. They also have exposure to some of the more riskier segments like real estate. So what's in store for them in 2021?
I think it's going to remain a bit challenging, but definitely lower challenges as compared to what we've seen in the recent past. A lot of these NBFCs have managed to scale down their balance sheet, divest some of the risky assets, and also raise capital to an extent. What's also helped them is in the current year so far, the first two quarters were largely washed out in terms of incremental disbursements. So the liquidity profile has improved quite substantially on the back of lower disbursements, and definitely the government and the RBI measures by way of PCG schemes, SLS, and TLTROs. From a market perspective, we still see a bit of a divergence in terms of few entities being able to get funds in larger quantums and finer prices, which is not the case for others. In that sense, we still await or we expect some sort of a support to continue into next fiscal as well, given that NBFCs are really important constituents of the overall financial sector. So if that doesn't play out, then possibly we do expect a lower growth on some of the stressed names in the sector. But otherwise, as compared to FY21, we should definitely see some growth as far as NBFC AUM is concerned, planning into FY22.
All right, Kartik and Alka, thank you so much for joining us here today and sharing your thoughts. Thank you.
Thank you.
All right, on that note, we'll wrap up this special edition of Outlook 2021. Thank you for watching and goodbye.